Now that all changes pretty quick in a resource bull market, right? The money becomes easier, the spending becomes more frivolous, more players enter the sector, increasing the risk for investors.
I don't think we're in that stage yet. And therefore, why we're so focused in this riskier part of the industry, which I think is where you can get leverage and where a lot of investors see it, unfortunately or fortunately, as a highly speculative side of the market.
What I love to do is introduce the right people to the right people. I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, Jay Martin here, CEO of Cambridge House, and I'm joined by Tavi Costa, portfolio manager and partner at Crescat Capital, located in Denver. Tavi right now is in Sao Paulo or close to Sao Paulo, Brazil. Tavi, how you doing?
Good, Jay. Thanks for having me. Look forward to this conversation.
Yeah, I'm looking forward to introducing you to our audience. And, a nice place to start for anybody who's not familiar with yourself or with Crescat, you're very active on Twitter. So I recommend people check out your Twitter feed. Always being recognized for the charts that you publish. People love your charts. But for anybody who's not familiar, let's open it up with can you give us a 30-second commercial, Tavi, on yourself and Crescat and what it is that you do?
Sure thing. I'm the portfolio manager of Crescat Capital along with Kevin Smith. We run a global macro hedge fund, long short, and a precious metals fund now focused. And I am originally from Brazil, moved to the US about 10 years ago, actually 12 years ago. I've been mostly focused, started really building models in the macro side by sort of evolving our investment process, which used to be a lot on the value approach of investing. And then adding to that layer of more of a macro thesis aside from this value investing approach. Kevin is the one that covers the other side. And by doing that, we really began to develop macro themes. And precious metals now is a big theme for us, why we launched a new fund in August. And we're really excited about the opportunities in the commodity space as a whole. I've had a tremendous, I think we've had a tremendous year back in 2020. And I think it's just the beginning of what we might see in the following years.
Yeah, so that's what struck me about you and why I wanted to have you on the show now, because your background isn't that of a gold bug, right? Which I appreciate. I don't consider myself a gold bug, although I'm a very active gold investor. I try to eliminate that bias from my brain as much as possible. You're a macro value investor, launched the Precious Metals Fund in August. When and why did you start paying attention to the precious metals sector, Tavi?
Well, I think Kevin has always been sort of more in that camp of more of a gold bug, if you will. But for me, it needed a few boxes to be checked first before we really come in and have higher conviction on this trade. I think that it all started with the yield curve inversion problem that we had in 2019, where I did an empirical analysis looking at the percentage of inversions in the yield curve in the US, for instance, and globally. And what we saw is that gold tends to outperform equity markets in the following years as you have that. Plus, you tend to see also a recessionary period as you reach those levels of imbalances in credit markets. So that was really the beginning of the thesis. And then we married that by looking at the commodities to equity ratio being a 50-year low. That made a lot of sense. And then looking at the lack of alternatives, it's very difficult to value gold. What is intrinsic value of gold? Well, one way to do it is just looking at the alternatives of other investments that you could do instead of gold. Well, one of them would be corporate bond yields turning lower, and now in negative terms, even below inflation expectation for the first time in history. You got $18 trillion of negative yielding bonds globally today. We have equity markets barely yield anything today in the earnings side after inflation. So it's difficult to find an asset that is cheap. And gold, as a monetary asset, has been sort of the history of it. And another thing that we find that I think it's even more important has been this what I think it's something we've been developing recently is this largest supply and demand mismatch that we've seen in the history of gold. The demand side is certainly driven by the macro imbalances that we have globally, but the supply side is something that I've never seen before from a CAPEX cycle perspective and from a discovery perspective and even a supply cliff issue that we're seeing in major producers today.
Okay. Now, let's break that down a little bit into the commodity sector. It is tough to find things that are cheap. It seems like everywhere you look, things are overvalued. I always wonder how new investors navigate the market because where do you start? Everything is hitting all-time highs simultaneously. But looking at commodities, when you're thinking about 2021, I mean, you had a great year in 2020. I think your precious metals fund delivered something like 155%. Investors must be happy with that. So what are you looking at for 2021 top commodity? What are you most excited about?
Well, I'm still very excited about not only commodities, but especially the precious metals space. I think there has been a decade of underinvestment in the space, this lack of exploration, declining CAPEX, the capital conservatism that we've seen in this whole space, and the fact that commodities have been out of favor. I tend to favor especially the precious metal side of things, as I think that that's going to lead the way. I think oil has a tremendous opportunity here ahead, has been lagging recently, a lot of the other more cyclical commodities in general, but that's a small position for us. Where we are excited really is on the mining space in an exploration side of the segment of the industry. You know, we've had miners, the larger producers are really cashed up now. We've had a largest repayment of that in the history of the data. The miners, in my view, are kind of in a new era. They've been through a 25-year of being capital destroyers, and that has been absolutely true. Just bleeding capital of free cash flow for a lot of decades, and finally we've had a 4 straight quarter of positive free cash flow being reported, with free cash flow growth of over 130%, at the same time as you have reserves not increasing. Discoveries of gold are not increasing. If those guys want to expand those productions, well, they have to do something about acquiring some of the best deposits in exploration side. So we partnered with Quinton Henney recently to really seek for those opportunities worldwide and find these strategic regions in the world where we can find gold and silver in relatively cheap way by buying those properties and getting a significant stake, and hopefully even a more activist approach where we help them out, and not only on telling the story, but getting them the capital, but also with Quinton's expertise and network to really help them to make those deposits come to fruition. So it's almost like from the macro side, looking at those companies becoming more cashed up and being able to really be looking for those acquisitions in the following years, as they have not been touching a lot of the exploration space. It's been sort of a speculative side of the market where I still think that it's why we see so many mispriced opportunities in that space too.
That's interesting. Yeah, I mean, Dr. Quinton Hennig is a very respected geologist in the space. For anybody who's not familiar, when I talk about following the smart people in the sector, I usually focus on the money team, the investors, or the CEOs leading the team. But, the geologists are worth a look, and Dr. Hennig is one at the top of the game. So you talked about potential M&A activity. How much, Tavi, do you think the lack of ability to travel has limited that activity in the last 12 months? And how much pent-up demand is that therefore creating once we're able to get back on airplanes and kick the dirt again? Do you expect a bit of a surge as that pent-up demand becomes released?
There has been a lot of people talking about this pent-up demand thesis. In my view, it's more of a supply problem that for me is really, and I hate to use the word unprecedented, has been used all the time, but really is. And it kind of reminds me a little bit, or I should say, by looking at the data and reading books about it, is 1919 during the Spanish flu situation. What happened was that commodities became rare, especially raw materials as a whole became rare, and that caused a supply constraint problem, where commodity prices began to rise and accelerated the problem with inflation. And now we're seeing here, after this decade of underinvestment in the space, it's kind of interesting that it's all matching up together. In my view, we had a 50% plus year in a lot of metals, silver being an example of that, and production is down. You look at a CAPEX cycle for silver, down 18% on a year-over-year basis, completely diverging from the metal price. Again, this is the same with gold. If you look at gold producers as well, you see CAPEX as a whole also completely collapsing still, not collapsing, but diverging from metal prices reaching all-time highs. That's something we haven't seen in the history of mining, at least for the last 30 years, I should say. And I think what's going to see here, what we're going to see here is that the thesis of deflationists of the money velocity problem, the technological advancements being deflationary and good deflationary issues. I think that's all going to be trumped by commodity prices rising and creating inflation. We have inflation expectation now beginning to break out from a long-term declining trend. We have commodities breaking out from a 12-year trend as well. So I think there's a lot of things going on right now in the market that is showing to us that there's an inflection point here for commodities. And I think that could be the end game for a lot of risky assets at record valuations. At what point we get here in the cycle that inflation begins to turn into a problem for the equity market? I think it's an important question for everyone. But I hope I answered your question initially. I think that pent up demand is a little bit. I think people are overshooting a little bit for that. I think it's a bigger problem on the supply side, personally, and certainly the helicopter money policies we're seeing now with Democratic sweep and all that. That's going to exacerbate that sort of inflationary force as well. So I'm more focused on the supply side, and the imbalances are really the demand, in my view, for hard assets that, in my view, are also probably have never been so compelling.
Yeah, okay, I'm with you. And you touched on something there, the disconnect in price performance between the underlying commodity and the miners of those commodities, the developers, et cetera. What do you attribute that disconnect to? And I see a trend right now of money diverting from financial assets toward hard assets, right? It makes sense. Things are a little uncertain, unstable. So why do you think there's a disconnect right now between the share price performance of these miners and the underlying commodity?
Okay, so those are two different questions. I think that the CAPEX problem has to do a little bit with the reputation of the mining industry that it's been it really hurt and forced those companies to be almost reluctant to spend capital, something we haven't seen throughout history. At the same time as metal prices rise and enable them to really expand their margins. So this is kind of new. The divergence between miners, for instance, GDX, just using an example, actually underperform gold this year in 2020, which is something, gold had a very good year. Why is that? Well, I think investors are still, this is just the beginning of this gold cycle in the bull market that I think we are, where we're going to start seeing investors really dipping their toes. It starts with the big miners, and then it goes down to the smaller names. We're already seeing a lot of big moves in the smaller names, at least in the things that we are invested in. But I think it's, at some point we're going to see miners really taking off. And I think it's, in 2021, it's probably going to be the year where we see this outperformance on the risk curve, right? So investors being rewarded by taking the risk of going down to the miners relative to investing in the metals. And I don't think a lot of people were really looking and doing analysis in the fundamental side of those businesses. Like I said, they are cashed up. Their balance sheets are looking cleaner and cleaner. They're making money on a free cash flow basis. And when you look at the aggregate market cap of the whole precious metals space, it's about, looking at the miners, those companies, the public companies, it's about $600 billion. That is 3.5 times less than Apple's market cap. So the asymmetry here for this trade is tremendous and is still here. And I really doubt that we're going to continue to see that in the following years. How many miners are in the S&P 500 today? Only one. We just had 25 plus trillion dollars of debt issued worldwide, $9 trillion of central banks adding assets to their balance sheets, and $8 trillion of negative yielding bonds worldwide, and only one miner in the S&P 500. And for me, those are the types of opportunities that we're going to see here in terms of flows towards this industry.
Right. And when you frame it like that, it's easy to see why people are so bullish on the miners right now. And you're right. If you look at the balance sheets, if you look at the competency of the management teams, if you look at the valuations, all are favorable, more favorable than they've been in a decade, likely. Right. Now that all changes pretty quick in a resource bull market, right? The money becomes easier, the spending becomes more frivolous, more players enter the sector, increasing the risk for investors. So talk to me about that, because that's the treacherous part of this business. How are you planning, Tavi, to manage the hype, right? As the market heats up and the noise increases, how are you going to stay safe?
Well, I think it's so early in the stage of this bull market for precious metals that I'm not so worried about the exit strategy at the moment. I'm always thinking about that, but I don't think we're in that stage yet, and therefore why we're so focused in this riskier part of the industry, which I think is where you can get leverage. And where a lot of investors see it, unfortunately or fortunately, as a highly speculative side of the market, where we find those tremendous opportunities that we can find those home runs for companies that can really create those gold and silver deposits for the following years to kind of especially help those larger miners looking for expanding their production side. I think that the situation of supply here is so constrained, not only in precious metals, but even oil. I mean, right now, oil inventories are still high and everything is fine. But things can change very quickly. If the economy just goes back to normal, you don't need to see pent up demand really catching up and completely taking the demand side to another level. You just need to go back a little bit to normal. So the normalcy situation, along with this constrained supply worldwide, is going to become an issue in my view very clearly. And I think a lot of investors are not paying attention to that. It's going to have a lot of problems, especially along with the monetary policy. We're seeing monetary policy becoming more of a funding tool to the government. That the Federal Reserve has to suppress rates through an expansion of the monetary base. It creates a supercharged environment for assets that serve as an alternative for the monetary system. So the Federal Reserve is forced to run the economy very hot. And at the same time as the global economy is at a risk of a commodity supply shock type of inflation. So, personally, I don't even know how to answer that question of how am I going to react to those issues that you pointed out, because I think we're so far away from that right now. But you're right. Yeah, there's going to be a point where we look at 3,000. There's over 2,000 companies that we like to look at in the mining space or so globally. 95% of those are probably not worth our investment, at least in our view. And about 5% of those, you got 3% of that is about there's a lot of ego. So you have to really screen your selection here of the universe of miners that you'll be investing. So Quinton does do a lot of help in terms of that, of helping us finding those opportunities. But it's challenging to navigate in the space right now still, and capital is starting to flow in, but not in the very small part of the market. Still, liquidity is so low. That's the one thing we hear all the time. Look, we love what you guys are doing, but liquidity is very low. Well, that's the opportunity. When liquidity is high enough, that's because the market already moved. So we like that right now, and hopefully in the following years, we will see more money coming in, and it will be misallocated, no doubt, like it happens with anything. It might be even create a bubble in the following years, but we're so far away from that that I can't even think about it right now.
Okay. No, that's fair. That's fair. So, 2021, you're most bullish on precious metals, gold, silver. Talk to me about how you have allocated capital. Can you touch on some of the companies you've got positions in and why you like them?
Well, strategic in terms of region, we're certainly very bullish on the Golden Triangle area, Newfoundland area. We have investments in Brazil and in some parts of Brazil. Bolivia is another area that we're interested as well. We have a few investments in Mexico. All of those are really in the exploration side. As I said, I think we have a supply cliff issue among the major producers that will be catching on to the news here in the following years. Market tends to move a little bit ahead of that. So that's sort of the opportunity in our view is to look for those good opportunities. We even look for co-investment of those bigger miners to maybe help us to really create liquidity for some of those smaller companies, and there's no interest from their side yet. So I think we're very early in those and able to really even get warrants and discounts on those private placement deals. That it's another example of why we're probably early in this bull market. As we keep moving on here, I think we're not going to see a lot of that going forward. Those deals are going to become a lot more competitive. But this is really the beginning, in my view. So exploration side is basically 95% of our precious metals portfolio today. We have a little bit of copper, and we have some allocations towards oil as well today. In my view, oil is right now an accumulation phase of any investor. You should be buying the dip in oil, in my view, today. I think there will be opportunities. Oil could even be, given how much it has lagged other commodities, it could even be the best performing asset of among commodities at some point this year. I don't know for the full year, and I don't need to be right about that. But I think there's an opportunity for oil to do really well in the next 6 months to 12 months or so. I think we'll see some flows towards that as well. But precious metals seems to be, I wouldn't say safer, but a higher conviction thesis at Crescat, and why we have a higher allocation or deployment of capital towards that today.
Okay, I'm with you. And I want to try to peel some names out of you. Are there any CEOs in the space that you back and you recommend people take a look at?
Oh, well, talking about company names, I think SK Mining is something that we got involved very early, on the potential opportunity of a VMS deposit there. And honestly, their land position here is just massive in the space. And for us, that was an opportunity by looking at the performance of a lot of the names in that region, especially in the middle part of the year, while SK Mining was really lagging that, given really the lack of findings in general in that, and being successful on drilling as a whole in that proper part of the property. But now, I think the market is finally rewarding SK Mining to one of the sides of the property, and we think that there's potential for perhaps even 5 to 7 VMS deposits in that whole property. So it still is a large position for us. Eloro Resources in Bolivia is another one that I think there's a lot of opportunity as well. There's a few others. Newfound Gold is something we got involved early. We still like it a lot. Labrador is another one in the same area that we like. Cabral is another one in Brazil. It's something that we liked a lot. There's a lot of new names. I mean, Novo Resources is something that I think a lot of investors overlook and tend to not pay attention to. They're going to go into production perhaps even in February, as early as February. When you strip out the value of the property and what they have in terms of stake on Newfound Gold, for instance, they own about 10% of that company. If you just strip out the ownership of other stakes that they have in different businesses, their own business is being valued at very low valuations today, relative to what it could actually generate in terms of free cash flow in a very conservative way. So I think that a lot of investors are missing that as an opportunity of a company that is more in the development side and about to become a producer. So those are the names that we're interested. Obviously, those are all with our involvement with Quentin Henney, that is the expert on the geological side of things.
Excellent. No, and I love that because he's a name you should watch out for on a presentation deck when you're vetting a company. You want to look for key names that continue to deliver success. Success begets success, right? So I'm with you on a lot of these, newfound gold. I'm actually talking to Cal Everett today as well, and big fan of his. So everybody watching this, most people watching this, Tavi, probably agree with your sentiment. We're bullish on precious metals in 2021 for the reasons that you described. So what I want to ask you is, how could we be wrong? What could occur that would prove this wrong?
Well, look, I think there's a debt problem worldwide, and that debt problem is something that it was the case years ago. We've had a situation where debt really surged relative to economic activity. And what would change would be some sort of innovation that creates productivity, and units of GDP begin to rise faster than debt. Okay. I don't think that's going to be the case here. And that's what I'm watching for, is anything that changes that picture and removes this dependency on monetary policy, not only as a funding tool, but also as something that depends in terms of the equity markets. I mean, we have record valuations in equity markets, corporate bonds, sovereign bonds, real estate. Almost everything depends on very easy monetary policy. If something changes along those lines, where we're not going to see that type of dependency, where even twin deficits begin to improve, something that really tends to really kind of exacerbate again this gold trade relative to equities, and I think that in terms of inflation, deflation, that really doesn't change the picture. I mean, in a deflationary world or low prices environment, still, I think there's no alternatives, and flows have to go towards commodities at some point. But I think that the end game for the business cycle as a whole, which I think is an important question that might even impact things like gold and silver and so forth, is at what point we start seeing inflation picking up. And a lot of people are not worried about that, given what happened after post the global financial crisis with the monetary money printing in general from Federal Reserve and global central banks did not create inflation. But this is very different than what happened back then. We're seeing fiscal profligacy is here to stay, in my view, and at levels that we haven't seen in a long time. And when you put it all together, right, you had a Democratic sweep, you had Janet Yellen's back, you got IMF calling for a great reset, you have the Fed saying, we're not thinking about thinking to raise rates. Got unlimited QE statement. It's kind of crazy to say this, but at 27 trillion of public debt, I think we're only getting started. So it's difficult to me to see some sort of innovation process that would change that picture. But it happened in the past. It certainly happened in the past. So something I'm watching for. But right now, if I see that, certainly we'll have to change our position from a macro perspective. Not something I'm expecting personally. I think, and also an important point that you asked, you said, it's not contrarian to buy gold and silver. You're absolutely right about that. It's not contrarian to buy Bitcoin. There's a lot of people that agree with any investor that likes those types of assets. What is contrarian, on the other hand, is to buy exploration names. There's a lot of people that wouldn't touch that segment of the industry. It's easy to go there and buy the Newmonts and the Barricks of the world. I want to see an investor going down the list and buying those very illiquid names because they see the opportunity, especially from a supply cliff perspective. And I think that's why we are so focused in that segment of the industry, because that is contrarian in my view.
I love it. We're pretty aligned in that. Okay, thank you so much, Tavi. I appreciate you coming on, sharing your perspective with my audience. I wanted to introduce you to our crowd and get to know you better, because I've been following you on Twitter and reading your content. You look like you had something to add there.
Jay, well, thank you very much. I also like the stuff you put out. It's really great interviews. So thank you very much for having me here. It's a pleasure to be here.